Hey Internet, what's happening? My name is Andrew, otherwise known as Drewicious. Welcome to Drew's Basement. You might be wondering why I call this Drew's Basement. We are literally in my basement right now. You are in a dungeon that is darkly colored but vibrant, and this is where I spend my time keeping my things. So thanks for stopping by. We're going to cover pretty quickly today part 2 of my foundational series for new traders. I'm essentially just trying to share some of the information that I wish I would have had when I first started trading. I hope it is helpful for you, and if it is not, feel free to stop and go look at cat videos. I am confident they have it covered. So, what we're going to go into today is some basic. I got to move over here just a little bit. There we go. We're going to go over some basic indicators today. I want to talk about moving averages, MACD, and RSI. They are three extremely common, maybe the most common indicators for day traders, swing traders, all sorts of traders. We're going to talk about some of the pros and cons, how they work, and then we're going to get out of here and let you get on to those cat videos that we talked about earlier. So let's get on into it, shall we? Part 2, as I mentioned, today, just indicators. I already told you which ones we're talking about, so let's start with them. Moving averages are probably the most common type of indicator. I don't know really anybody that doesn't at least start there. A lot of traders I know continue to use them. They are useful. They have their limitations. We're going to go through some of those here, and some of the pros and cons as well. So what is really important to note about most indicators is that they are lagging indicators. That essentially means that they are telling the story about the past, and that can help you get familiar with where you're at in the present time, but it does not in any way give you a proof, guarantee, solid information, take your pick, of where we're actually going, right? So you can use it to help make some inferences about where things might be going, but at the end of the day, it can only tell you what's behind you. It is like a rear view mirror in your car, right? And you know, is that useful information? Absolutely. Will it tell you where you're going or if you're about to hit something? Definitely not. So it is important to bear that in mind, that these moving averages do not actually drive the market. They are sort of a trail that gets pulled behind what's going on, current price action. And the best you can do is try to use it to keep in mind whether we're on the way up or on the way down. It does not guarantee you that we'll continue going in that direction. Now, with moving averages, the only thing they look at is price action. There are two main components when we watch any sort of a bar chart type of interface. We're looking at the price action and we're looking at the volume. So the moving averages only measure the price action. You have to get your volume information either from a direct volume indicator, from the volume itself, or from an indicator like OBV that focuses on the volume and what it's doing. So just bear in mind that there can be things here. It can be misleading, right? We can see a huge bar without a lot of volume behind it, and that is a bad signal. So you don't necessarily have to worry about that as a new trader, but it is something that you should look for and be curious about as you develop your skills and become a better trader. Now, what's nice about the moving indicators, or the moving average indicators, is that they can help you identify momentum. They can help you tell whether you're in a range, right? If you're in a small spot where you're just kind of bouncing around a little bit, or they can help you see whether you've made a strong move up or strong move down. So they are very good at that job. In fact, they're exceptionally good at helping identify those trends if you're on the way up or down. So the problem, however, is that they're not super useful when you get into those ranges. When the price starts to chop around between kind of an upper and a lower area, moving averages can get confused. If you're using multiple moving averages, they can get tangled up. And so while they don't necessarily tell you whether you're on the way up or on the way down, that in itself is actually a good signal. So if you see moving averages getting tangled up, that is an indication that you are in a range. And if you're not interested in playing ranges, you can definitely play ranges, but you don't have to. And it is tricky. So for newer traders, it may be best to stick to trending markets. If you see them getting tangled up, that may be a sign to just sit on your hands and not take a trade at all. Now, there are many, many different types of moving averages. The two most popular are the simple moving average and the exponential moving average. There are very subtle differences between them. The primary thing to keep in mind with them is that the simple moving average is doing a very, very simple mathematical calculation of the last however many sessions you include. So when you pick a moving average, you are saying, hey, I want you to tell me the average of the last 10 candles, 20 candles, 100 candles. That is part of what you're selecting. When you say that I'm going to do a 50 MA or a 50 EMA, you're saying, I want the average of 50 candles. So the smaller that range, the faster your average is going to move. The longer that range, the slower that average is going to move. So there are different uses for those. We'll look at that just a little bit here as we bounce into some of our examples, which I think maybe now is a good time for that. So we're going to get those slides out of here, and we're going to take a look here at a live chart. This is a chart that is moving right now. We're looking at ES, which is it is related to SPY and to SPX, if you're familiar. So we're looking at this in real time. We're on the daily chart right now. I got a bunch of indicators on here. We are actually going to talk about some of them, but right now we're just kind of focusing up here on the price action. And you can see, I mean, I've got here, let's get this, let's get that out of the way and get this kind of simplified a little bit. I'm going to leave that trend line there. It is helpful. But I don't have any indicators on this chart, right? It is just candles going up and down. And I know I got a bunch of colors on here. Ignore the candle colors, but right, you can see we're chopping around, we're moving up and down. You can see that we're on a general downtrend here, but there's nothing here telling us whether, where we're at right now is above average or below average. So I'm going to go in here. I'm going to turn on, we're going to start with, let's just say the 20 simple moving average. So we're going to enable the 20. And we're going to see what that looks like on our chart. So there's the 20 moving average. And you can see that it follows pretty closely. You can see here when the price comes below it, right? There's a nice move down. Price moves up, chops around a little bit, comes down again, right? So we're trending up above the moving average and we're trending down below the moving average. And that is generally the way that moving averages work. They help you identify that we're on the way up because we're above a thing, or we're on the way down because we're below a thing. But as we start to change out that value, right? So this is the 20. If we turn off the 20 and we turn on, let's say, the 100, it's going to look pretty different. So there's the 100 moving average, right? And as I mentioned earlier, we're adding up now a lot more candles. So we're getting a slower signal, which is, if you think about it, more powerful, right? Knowing where we're at in relationship to 100 days gives us a very good sense about, generally speaking, over the last couple of months, are we on the way up or on the way down? And you can see here, for a period, we were very much in an uptrend, right? But all of a sudden, things changed. We came down below, and then we had trouble getting back above that moving average, right? So as we broke down here below, we spent a number of days below. We came back up, but couldn't hold on to it. Bounced back up, couldn't hold on to it. And now we're coming back up here again above it. And, maybe we're going to hold on, maybe we won't. But as you look at this average, you can see that we kind of arced up, we flattened out a little bit, and then we started to trend down here a little bit. And as we look at what's going on here, well, maybe we're flattening out, and maybe we're about to start reversing and heading into an upwards trend again. Entirely possible. But that's the power of the moving average. Now, the simple moving average, like I said, is just a very basic, give me a bunch of numbers and I'll divide it by the number of sessions that it came from, and that is your current number. That was really not maybe as helpful of a description as I was hoping for, but it is not doing anything special with those numbers, right? It is just looking at those days and averaging them out and saying, hey, here's where you're at in relationship to the last 100 days. exponential moving averages are a little different. Now we're going to switch out here. I think I had on the 100 simple moving average. We're going to turn that off. We're going to go back to the naked chart here. Right now we have no indicators whatsoever. Now we're going to turn on one of the exponential moving averages, and here's what you're going to notice. And I'll turn it on first, and then we'll talk about what you're going to notice. We're going to turn on the 50 EMA. Now the 50 EMA, I don't know, looks an awful lot like the last EMA. I'm sorry, the simple moving average, but we're going to now turn on the 50 simple moving average as well, and we're going to look at the difference between the simple and the exponential. The reason this is interesting, and the reason that people are interested in the simple versus the exponential moving average, is that the exponential average gives a bias or a preference to more recent price action, which means it moves faster at the beginning of the indicator itself. So it trails a little bit longer. So you can see, as you know, kind of towards the back here, these lines are fairly close, but as we get closer to the front of the price action here, you can see that the exponential moving average moves a little faster, even though these are both 50 moving averages, right? The exponential is 50 and the simple is 50. The exponential moves faster. Now, I don't personally find the exponential all that helpful on the daily chart, but when we are doing intraday trading, and we're going to go in here to a 5-minute chart, there are a lot of traders who prefer the exponential moving average to the simple moving average on the daily or intraday moves, because the exponential moving average tends to go quicker and follow price action. So it can give us quicker entries. It can give us quicker entries, but also can give us slower exits if we're simply looking for crossovers. At the end of the day, like I said earlier, the moving averages don't actually make the market do anything. They're just sort of there for humans to try and make some meaning out of the movement of the bars. So what's important here is to play around with these averages in order to find one that helps you tell your story, right? What's important is that your eyeballs can look at a chart and start to get an edge, right? That you have a statistical edge of determining whether a play is likely to go up or likely to go down. And that is the only purpose that these serve. So, I know when I got started in trading, I was very interested in what EMAs or SMAs everybody was using. There are a bunch of common ones out there, right? For SMAs, the 5, the 10, the 20, the 50, the 100, the 200, those are all very common, simple moving averages. There's nothing magical about them, other than probably a lot of other people are using them, and they can have a psychological effect on the way that the price moves. For EMAs, those tend to be a little bit more esoteric. I know people that are on, the 5, the 9, the 11, the 13, and there's nothing magic about those either, right? Those are just numbers where people have played around with it enough in order to say, hey, this number helps me see the chart more clearly. I can see that the price is coming down and testing off of the 13, and that helps me feel like I'm going to get, a rejection or a retest, and that, the price is going to continue or reject in a way that I anticipate. So what I would encourage all traders to do is play around with those things, get them up, tinker with them, and try to figure out how you can tell a story over the course of the last couple of trading days, right? Just come in and look at a chart and move around those numbers until you see something that makes sense to you. That is the whole point of these things. So that is the way in which I would think about moving averages as a concept. Going back to the slides here, we're going to talk next about MACD. MACD is another lagging indicator. It is a momentum indicator. It stands for moving averages, convergence, and divergence. The idea here is that it helps, in some ways, if you set up your indicators, if you set up moving average indicators in the same way, you can get a lot of the same information as MACD gives you. One of the big differences from MACD and just having, EMAs on your chart that are using the same number of sessions is that they give you a histogram. And we're going to look at a live example of that here on the chart. But once again, it is a momentum indicator. It does only look at price action, so it tells you nothing about volume. But it can help you identify momentum inside of a given section of price action. It does excel more in range trading. In trend trading. So it can help us identify whether we're going up and down, and it can also help us identify reversals. They are not guaranteed, right? No indicator is bulletproof, right? The idea here is to take information from different things that are helpful in order to build a confluence model to give us a confidence on the trade that we're looking to take. So I do use MACD. I use moving indicators, MACD, and the other one we're going to talk about here, RSI, to a certain extent. Something important to note is that they are less reliable on smaller time frames, and that is kind of consistent. Generally speaking, if you ask anybody about the difference in time frames, the lower your time frame, or the smaller amount of time that you're looking at, the less reliable patterns and charts and indicators are. Which is not to say that they can't be helpful, but they get stronger and they get more useful as you add and condense more information into the candles and the price action on higher time frames. So that being said, let's go ahead and take a look at MACD. We're going to go back to our chart here. And I've got MACD right here. This lower indicator right here is MACD, and you can see it's a little tough to see here on the 5-day. So we're going to go back to our daily. And you can see MACD here is, we got two lines here, and you can see it's kind of swinging up and down. And it does, in some ways, follow what's going on with the price action, right? So once we see this crossover up here on MACD, the histogram starts to indicate that we are picking up momentum on the way down. And if we go up and see what the price action is doing, right, there's our crossover in MACD right here. So right about there, price action heads down. And, and here it looks like it's going to cross over, but it doesn't, right? There's a big drop off candle here, and we continue on down again, right? So, and this is where MACD can help you identify a reversal, right? This is basically saying, hey, it looks like we might be about to reverse, and the price does not have to observe that. And clearly here it did not. But if you follow that trend down a little bit further, right, we start to see some crossover here. We actually see two crossovers where we have this blip here, right? We might be starting to head up, and we changed our mind, but then we did actually start to come out of that a little bit. And then the histogram actually says, hey, you're above the zero line. This line here in the middle is called the zero line, with the general idea that if you have a histogram above that, you are generally bullish. If you have a histogram below that, you are generally bearish. So this whole play to the downside here, we are showing red histogram, and then as we start to pull out of that, we're starting to show, I don't know if that's green or yellow, I'm not sure, I'm colorblind. But this bright color here helps us understand that there is a change in the market, and we are now starting to be a little bullish. And if we look here at the moving averages up here, they don't tell us any of that, right? This moving average down here, and this is all based on the 12 and the 16 EMA. I think, up here we're looking at the 50, I think. So part of the reason these don't match up is because they're looking at very different numbers of sessions. If we were to change this to the 12 and the 26, it would look probably pretty similar. And you can change these as well. So as you get in, if you really like MACD as an indicator, you can change these out if it helps you identify your ranges a little bit better, your trends a little bit better. So again, experimentation is key, because your goal should not be to find the magic indicator that tells you the story. It should be to work with indicators to help you build your story. What's important here is that you see the trades and that you understand what's happening, not that you're doing what everybody else is doing. It is a sure recipe to lose a lot of money if you just do what other people are doing and don't put your own critical thought into it. That is part of the way that that trading, really successful traders work, is that they start to build their own relationship with the data that's available. All right, so that is the MACD, and we're going to go ahead and finish up here with our final indicator, which is RSI. Once again, lagging indicator, also based on price action. It functions a little bit differently than just looking at whether we're going up or going down. It does a slightly more complicated mathematical transform of the volume, or not the volume, the range of a move up and the range of a move down. So it provides a slightly different take on what is going on inside of the price action. Now, the main point of RSI is to help identify reversals. So relative signal indicator, or I'm sorry, relative strength indicator. The idea here is that when it gets too high, means that the price has moved too far in that direction. And from like a reversionist perspective, we may be looking for a pullback. Now, it does not mean when an RSI indicator gets too high or gets too low, it does not guarantee that you're going to get a reversal or a trend bounce in the other direction. In fact, RSI is particularly weak in trends. On trending days, you can see RSI just pinned to the top or pinned to the bottom, depending on which way we're going. So RSI is specifically not helpful inside of a range. That's where MACD and the moving averages can be more helpful. But when those indicators, the MACD and the moving averages are not helpful, RSI can be helpful. So when you are stuck in that range, RSI can kind of show you, hey, I'm on the way up, I'm on the way down. So let's go ahead and take a look at RSI. Again, I've got that here on my chart. RSI is down here. Now, normally I actually stack RSI on top of my volume. You guys can play around that too if you want to, but I did break it out down here so that we could look at it for this session. So you can see here that the RSI is, again, we're on the daily here. RSI is bouncing down here, and you can see when we hit kind of a low, what happened? Well, when we hit this low right down here, you can see that we bounced up. Now, we didn't get all the way up to the 70. Now, there are two kind of, in most RSI strategies, there's two kind of important levels. The 30 at the bottom, whenever we hit 30, which is kind of where we're at here, and this is this line, 30 is considered the oversold level. Now, we can definitely dip below that. You should not just assume that a stock is going to turn around when it hits 30. It may not. In fact, there's a good likelihood that it won't. Nor does it mean that you have to get to 70 before you reverse. Because if you take a look here, right, we got down to 30 and we did actually bounce out of that. And then we got up to this point here and we weren't anywhere close to 70. In fact, right there, we're like right around 50, right in the middle, right? But it rejected and you can see that the RSI agrees, hey, we just rejected and we turned back around again. But then we got back down here to the 30s. And you can see that didn't mean that we rejected. We actually got below 30 a little bit here before we saw a little bit of a bounce. We didn't get much of a bounce. We came back down and tested again. But then we did, let's see, right about here. Now you can see here there's a little bit of divergence, and we'll talk more about divergence in another video. But right here, the price action, the RSI says, hey, we're at a very low point right here. And you can see that low point right there. But if you look at the price action, you can see that there's a lower point over here. But RSI actually doesn't put in a new low at the price. There's divergence here because RSI is lower on this price than it is on this price, even though that price is lower than the one where RSI was lower. So this right here is known as a bullish divergence because the RSI indicator is actually starting to move up even when price is moving down. And you can see what happened when that divergence played out. We had a nice move to the upside. So again, that RSI played up. We haven't hit 70 yet, right? There's nothing here that says that we're overbought yet, right? We have only been oversold, but we can also use this on lower time frames. So let's go down and look at this on the hourly. Well, on the hourly, we are hitting the 70 here. And, you know, again, we hit that 70, we reject a little bit. We go back up, we hit that 70, we reject a little bit. We come down, we hit that 30. Now, we didn't necessarily reject all the way out of it, right? You can see that all of this action right here was below the 30 timeline or below the 30 level. But eventually, right, we didn't just keep going there. We did eventually kind of bounce out of that. And that is typical, right? Nothing goes straight up or down. Things tend to bounce around a little bit as they find their balance and as traders agree on what the true value of a given ticker is. So, you know, and if you look to, if you combine the information that you're getting from RSI and MACD and your moving indicators, your moving average indicators, you can start to construct that confluence model that I talked about a little bit earlier, right? Which is you should be doing mental checkdowns when you look at taking a trade. Aside from having a sense of what is your risk to reward, again, a thing we're going to talk about in another in a video here fairly soon. You can use this to help start to build, hey, is RSI bullish or bearish? Is MACD bullish or bearish? Are my moving indicators bullish or bearish? Am I seeing bullish and bearish candles on the chart, right? Like these are all things that we can use in order to sort of aggregate together like, hey, I've got 3 bullish looking things and 2 bearish looking things. Maybe this isn't a great trade. If everything's looking bullish, your confidence might be a little bit higher, and maybe you're feeling good about taking that trade. If you're getting mixed signals, it's probably a good sign that this is not the right time to take a trade and you should sit on your hands. And I say that like I've got all the wisdom in the world. There are definitely times where I fail to sit on my hands. I think I see something. I'm excited to take a trade. I got a time pressure. Please try to avoid it. I know I am working on that for myself, my own diligence and my own psychological craft in trading. But I know this to be true that if you can't get a lot of things that indicate that something is about to move in the direction that you're looking for it to go, you shouldn't take it. It's okay. Not taking a trade means you get to keep all of your money. Taking a trade and being wrong means you lose some of it. And look, losses are absolutely inevitable in trading. It is, in fact, a healthy part of it. You don't have control of the market, and being wrong in a given trade does not make you a bad trader. We don't have control of the majority of things inside of the market. So give yourself a break. If you lose a trade, even if all of your Confluence indicators, if everything lines up and says this is a surefire trade, you may still lose because somebody had a bad day somewhere else, because there was some macroeconomic news or some geopolitical information somewhere that caused the market to go the other direction. It's okay. You can fix that by managing your risk. Again, we'll talk about that soon. At any rate, these are the most common indicators. There are many other indicators. There's a lot of other indicators that I'm using, and the truth is some traders don't use any indicators at all. They simply look at the chart and they trade on raw price action. And there are things you can do there in terms of identifying candles, looking at trends and series, things like that. And I would definitely consider that more advanced. I don't really even consider myself all that good with it. I still definitely rely on indicators to help out, but it is a great way for new traders to get started. And I hope that this gets you started on being curious, going out and experimenting with other indicators, right? And again, whatever platform you're on, go through all the indicators. Spend a day and just play with indicators and see if they help you make sense of the price action in front of you. See if they help give you an edge. And honestly, if you find something you love, drop a note in the comments, hit me up about it, make your own video and tell me. I'd love to see it. Like, I am constantly on the lookout for new things that help give me an edge in the market. And I hope that you are interested in finding things like that as well. All right, everybody, this is the end of this video. I hope it's been helpful. Please drop a link, throw a thumbs up on there. Anything you can do to help out, it's greatly appreciated. I will keep putting more videos out. I think we've got, 3-4 more of these things for the foundational series. So I'll see you guys on the next one. Take care of yourselves till then. Cheers.
Shit.